Today is Monday, December 18th, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Mark Soderberg, ADMIS Senior Ag Market Specialist, and Alan Bush, ADMIS's Senior Financial Economist. Starting with the grains this morning with Mark. What factors will drive grain prices this week and into year end?
Well, we'll continue to monitor the weekly usage data such as exports, ethanol production. We'll also get a monthly update on renewable and biodiesel production and capacity before year end. But South American weather really is going to be the key factor in the price discovery process. Planting operations are winding down in Brazil while hitting the home stretch in Argentina as well. Weather in Argentina and much of southern Brazil has been mostly favorable. The biggest problem in these areas has been too much rain at certain times the past few months. So the biggest concern right now overall in South America is the lack of rain and extreme heat that has impacted the northern and central growing regions of Brazil. It has caused some planting delays with soybeans, which will have a ripple effect of delaying the second corn crop plantings as well late next winter. But these drought areas are expected to see some better prospects for rains by midweek this week and extending into year end, which, if realized, will at least provide some temporary short-term relief. However, much more rain will be needed into the new year if we're going to recharge soil moisture and halt the declining yield prospects.
Mark, you mentioned corn. So, what will it take to get corn prices to bottom?
Well, since peaking in June, corn has really been in a kind of a one-step forward, two-step back trading pattern, while export demand and the usage for the production of ethanol have been reasonably strong. It just hasn't been enough to move the needle much. U.S. stocks at over 2.1 billion bushels is at a 5-year high and just continues to dampen every rally attempt. The market was hopeful for some potential year-end bounce here if corn-based ethanol deemed eligible for certain tax credits for the production of sustainable aviation fuel. However, that decision now appears to have been kicked down the road a little bit into March of next year. Money managers are short and they appear poised to stay this way, rolling these positions forward, capturing the carry in the market. So keep an eye on the spreads. We'll just have to stay patient to see if there's any weather problems in South America or something else that just comes along to encourage U.S. demand enough to reduce supplies under this 2 billion bushel figure. For now, I do see some key support just below the market at 470 and then at 447 basis the March futures.
And finally, Mark, will this trend where index funds continue to exit the ag space continue into 2024, or do you expect this asset class to begin to expand their holdings?
Yeah, since peaking in the spring of 2022, index funds have been seeing their holdings in the ag space drop by 38%, and that's the lowest level since September of 2019. Some individual commodities are down even more, with corn off 56%, down 40% in soybeans, while in Chicago wheat's down over 60%. The selling from the index funds really started as the Federal Reserve began their campaign of higher interest rates to combat surging inflation. Remember, oftentimes these index funds are used by asset managers as a hedge against inflation. Now that inflation is down to just over 3%, but still above the target rate of 2%, however trending lower, it would appear that the Fed is done easing or done raising rates, and in fact start easing rates into 2024. So, and if that's the case, I would expect index funds will start to see net inflows next year, providing some element of support for ag futures.
All right, thanks, Mark. Turning it over to Alan. Alan,
yes.
What are the potential market-moving reports for this week?
Okay, well, on Tuesday, we'll have the November housing starts guessed at 1.36 million and building permits at 1.47 million. Then on Wednesday, the December Consumer Confidence Index anticipated to be 103.4. Thursday, we'll have the third quarter gross domestic product guessed at up 5.2%. And November leading indicators predicted to be down 0.4%. And then on Friday, we'll have durable goods with the guess there at up 2.4%. November personal income anticipated to be up 0.4%. And the December consumer sentiment index, that is predicted to be 69.4.
Another question for you, Alan. Why are Federal Reserve officials' comments less dovish now after Wednesday's dovish FOMC statement?
Well, after we had the FOMC statement and Powell's press conference on Wednesday, which were surprisingly dovish and implying that there could be as many as 3 interest rate reductions next year, Fed officials, in their usual fashion, are attempting to soften the message as they have done in the past when there is a major reversal in policy intentions. So recently we had policymakers, including New York Fed President John Williams, Atlanta Fed Bank President Raphael Bostic, pushing back on these expectations. And even today we had Fed Bank President Loretta Mester indicating that the Fed is maybe a little bit ahead of the expectations, and traders may be looking for too much from the Fed next year as far as rate cuts. So some of these Fed officials, I think, are attempting to walk back Powell's comments, which is, I think, more of a softening move or a smoothing operation. Usually the first statement is the intended statement, and subsequent statements are tended to be a bit of a softening operation.
All right, Alan, and finally, what are the likely price movements for currencies into the end of this year?
Okay, well, we have the newly dovish Fed. The likely catalyst to take the dollar lower into the last part of this year. All of the other major currencies, I think, will probably trend higher against the US dollar for the same reason. But the yen may be the leader. The Japanese yen probably could be the leader to the upside, since the Bank of Japan will actually be moving toward becoming more restrictive next year. Of course, they have their negative interest rate policy right now, which will probably come to an end next year. So interest rate differentials are likely to positively affect other currencies and support the other currencies against the dollar. But I think the yen could be the leader to the upside, as interest rate differentials tend to favor the yen more than other currencies. So look for the dollar to work lower, all the other currencies likely to work higher into the rest of this year.
All right, thank you both. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you would like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com. Thank you.